Hey everyone, this is Eric Bond. I'm one of the co-founders of Hustle Fund, and welcome to today's session, which is called How to Pitch a VC versus an Angel. So money is money, right? Who cares where it comes from? You need money to unblock yourselves, to underwrite the work that you want to produce, the milestones you're trying to hit. Who cares, right? Well, it turns out that there's a big difference when money is coming from an angel versus a VC, and that comes with different sets of expectations. And in addition to that, the way that you pitch to a VC versus an angel is actually quite different. And I did not appreciate this lesson enough when I was a founder about the nuances between what it's like to pitch a VC versus an angel. I thought cash is cash. People want more money, whatever, right? Give me your money. I'm going to turn it to $1, turn it into $10. Well, we're going to talk about these nuances today in today's session. And I'm very excited to talk about this topic because it's actually one of my favorite nerdy topics to talk about, which is the differences between VC versus angel. So what I want to do was to first give you a sense of what we're going to cover today. I'm going to go through it really briefly. I won't spend much time talking about myself. Many of you have seen me, heard me, but who really cares who I am? Let's just get to the advice. We'll talk about some of these differences that I'm citing about the VCs versus angels, expectations, and so forth. And then we're going to get tactical. We're going to talk about finding, reaching out to, pitching these entities. So the goal here today, because I tend to be quite talkative, is to try to get through this material swiftly but comprehensively so that we can leave plenty of time for Q&A. And by the way, you may have noticed that this is a Zoom session. So for those of you who are not familiar with Zoom, which is pretty much, someone that's been living in the caves for 2020, there is a Q&A box at the very bottom of your panel where we would prefer you to submit your questions. We always love seeing chat, but it's a little bit difficult for us to sort the Q&A. And when we get to that Q&A section at the very end of today's session, my wonderful colleague, Kara, is going to be participating and helping to moderate some of those questions, serve those up to me. And also my wonderful colleague, Mike, will be here along for the ride for some part of it today to help with some answering of those questions along the way. All right. So before we jump into the materials, I just need to say that it's not possible for us to do these sessions without sponsors. And we are very lucky to have an awesome sponsor, GS Futures. And I want to take some time to introduce this team. GS Futures is a new multi-stage VC fund that launched just this year, investing into teams at the early seed all the way through Series D. This team spun off from the GS Group in Korea. It's a legendary enterprise representing assets in retail, consumer, energy, and much more. GS Futures is actively seeking and investing into great hustlers. Go to their website right now, gsfutures.vc, and tell them what you're up to. I think you'll be excited to partner with them. Okay, so let's talk about me for a second. Who cares, right? You're not going to remember anything about my bio. Just note that I've raised a bunch of money, both as a founder, but also as a VC, and plenty from individuals, from family offices, from other venture capital funds, institutions. And hopefully we can channel some of those experiences your way in today's session. So let's start with the most important thing to consider when you consider your financing options. And specifically when it comes to raising venture capital, angel, anything that will ostensibly sell equity of your business. Don't do it. Okay? If there's a path for you to run your company without raising any angel or VC funding, where you can bootstrap, find non-dilutive sources of capital, anything else besides VC and angel financing, do that instead. Okay? I can't emphasize this enough. Like, I'd rather own 100% of a $10 million outcome as a founder versus 10% of a $100 million outcome as a founder. I mean, like, the threshold to sell a company at $10 million versus $100 million is pretty different. So you can de-risk yourself just thinking in terms of only cash. And that's like maybe there's other reasons why you want to build this company too. But just like, please just consider other options. All right. That said, if you guys are still foolish enough to continue today's session, by the way, if I've convinced you, feel free to drop off, leave. I probably did you a big favor in that 2-minute presentation. But if you're still interested in fundraising, let's proceed. So let's talk about the differences between angels and VCs. Let's do a little bit of profiling here. So an angel investor is technically anyone who's an accredited investor. So in the United States, there's a definition of an accredited investor as someone with either $1 million in net worth, less their primary residence. So their expensive ass house in Orange County doesn't count, towards their net worth. It has to be non-real estate assets, or I guess primary residence real estate assets. Or you're earning $200,000 per year for 2 years in a row as an individual. Or if you have a life partner, a spouse, whatever, jointly filing taxes, you guys are both earning collectively $300,000 for 2 years in a row. So that actually does widen the pool of anyone who could potentially be an angel. And we're going to sort of talk about how you should sort of expand your thinking of the definition of angels soon. Some of these things seem pretty obvious, but they become very important in terms of consequences. So an angel invests off of her own balance sheet, their own checking account, cash. They have no other external investors, right? So it's not like someone is giving them wealth for them to steward. And in general, this isn't true of all cases, but I tend to find that the decision-making speed of angels tends to be far faster. It's sort of just like me sitting down with founder Kara. I like what she's up to. Here's a YC safe for us to both sign. I can wire you the next day. So let's talk about venture capital institutions like Hustle Fund. Okay, so we are financial institutions. I have to file with the SEC every year and FINRA. There's certain kinds of laws that bodies of law that actually regulate our industry that I have to comply to. I have a boss also. So my bosses are my LPs, my limited partners who have invested their wealth or their capital into our institution. And I am held accountable to making sure that we are stewarding their wealth well. That's one part of the social contract. I'm not going to talk about the other part of the social contract and what we're trying to do to solve for founders too. The math behind running a fund is far more complicated than I could have ever imagined when I started this. It's not good enough for us to see like Kara doubling our money, like our investing her $1 into her business and she returning $2 back. That's not going to push the needle in terms of the return expectation necessary for our LPs. And we're going to talk about this a little bit further. And we do need to recognize the fact that if we don't produce returns, we're not going to have this job. And this is a full-time job for us. Like as angels, oftentimes they have other day jobs or other kinds of going concerns that they're running, but this is the only job that I have. And last but not least too, there's a bizarre affinity for Patagonia vests. At Hustle Fund, I think there's only one person, Shein, our GP in Singapore, who owns a Patagonia vest. But even she can't wear it because she lives in Singapore. It's too hot. So anyway, I could have thrown in Allbird shoes too, but I chose not to for space reasons on the slide. Okay, so let's talk about some of these nuances here. And by the way, I see Kara back on the screen here. Is there questions coming in, Kara?
There's one clarifying question. Can you explain the difference between a VC and a CVC, or a corporate venture capital partner?
Yeah, good question. So CVCs, I think it's a different kind of institution entirely. So I would say that they are somewhere between angels and VCs. The reason why is they don't have external LPs per se that are the same as a venture capital institution. It's usually just like Kara runs a huge multinational publicly traded company called Kara Corp. And then she's like, I want to invest in more founders who also do fintech like I do, right? And so she'll carve off maybe $50 million from cash in her own big business and ask a team to form to begin investing directly into companies. So best classic examples of this are like Stripe. Stripe has an amazing venture capital fund, and they don't have to raise any money. It's all based on their own balance sheet. But I would say that on the spectrum, they behave much more closely to venture capital firms than angels. So maybe that's one kind of course correction I would say. But that's a good question. But I'm not going to really touch CVCs too much in this presentation. although we can touch it in Q&A, but great question.
Thank you.
Thanks, Kara. And thanks, questioner. All right, so let's get back to the differences. I'm not going to read this slide to you. You guys can read it yourself. But let's talk about the conclusion here, which is I think that there is a longitudinal perspective that you should have when it comes to raising capital. Like what happens earlier in your company's life versus later. And I largely fall into the camp that most founders are better served focusing on angels early on, once they're getting going with their initial financing, and then focusing maybe on institutional venture capital firms later on. The only exception, of course, is Hustle Fund. We love to come in early, but let me stop being so tacky there. So the reason behind this, by the way, is just like a few things. Angel rounds early on. If you party around, let's say a couple $100,000 with a bunch of rich people, it's cool. It's gonna be a faster decision process. You'll get the money faster generally. And also there's no like negative signal. So sometimes people worry like, well, if it's a bunch of random people, is it gonna look weird later on to a VC firm who's judging me? Not really at seed. Later on, though, when you're raising, let's say, $2 million or more, or even $1 million, it could make sense to bring in someone who's a little bit more strategic, where you want to possibly form a board, find an investor who has very heavy skin in the game so that they're going to be incented to help you through the rest of the journey. And VC firms tend to be a little bit better suited for a bit later. So how can you find that money? This is actually the top question that we get at these sessions, but just generally from founders is like, this is all great, the theory of how you pitch, all that stuff, but like, where do I find it? Okay, so let's get into this. So for those of you who know my weird partner, Elizabeth Yin, and I say this in the most, so let me take a little meta context thing. Like our love language at Hustle Fund is just trolling each other mercilessly in public. And so if I say mean things about Kara, Mike, or Elizabeth, it's only because I love them so much, right? So my weird ass partner who's obsessed with hippos, Elizabeth Yen, my co-founder, who's incredible. She famously said that like one of the first people that she pitched was her dentist, right? So let's go back to this notion of accredited investors. Again, it's anyone that has $1 million in net worth or is earning at least $200,000 a year, 2 years in a row. Let's just take that simple definition. Dentists, doctors, lawyers, your neighbors, there's a good chance that there's people in your life that can meet this threshold who do not know that they're an angel investor yet, but you can convince to be an angel investor. For our first fund, Elizabeth was literally in this position, with like gadgets in her mouth, begging for cash. By the way, that pitch never worked out, but we're going to try to do this again, I think in Fund 3, because we just love this dentist. So really start to get creative about like the people in your life whom you've already developed, I think, a very strong social capital with, right? That there's some sort of underlying trust to see if they can get excited about supporting you early. And every check matters. So let's talk about some of these resources that I like to use, or at least direct to founders when it comes to how they should go about finding their initial angels and VCs. So again, I'm not going to, maybe I won't read the bottom 5. You can read them yourself, NFX and so forth. But let's talk about current investors and other founders. So this is a little bit of a chicken egg. So if you haven't gotten, let's assume that you've gotten like one investor so far, right? I would say that that is a very high signal introduction when your existing investor can open up their Rolodex or virtual Rolodex and make those referrals. It's always much more powerful to find introductions to new investors from someone who's already invested, right? So the way to sort of think about this would be like, I would like take a look at my existing investors, go on their LinkedIn, see all the second degree connections that they have, and then do the work for them of just like, hey, can you introduce me to these people, and say that you're an investor. Other founders are also really strong. So if the thing that we've noticed, I think, in our careers, and this is, I think, something that's true for you as a founder, is great founders tend to be friends with other great founders. And maybe even stronger, a referral is when a founder reaches out to her own investor and says like, my friend Kara is incredible, and I really think that you should talk to her about what she's up to. So one of the problems I think that's institutionally wrong with finance today in VC, especially, but less so in angels, is the need for warm referrals. It's actually, I think, a practice that is very non-inclusive, but it is something that I think is starting to change. And for now, if there's ways for you to play within those rules through your existing investors and network, that's to your advantage. There's a headline here that I'm sort of ignoring here, but I think it's a big one, which is assume 100 pitches for every 100K raised. So this isn't going to be true for everyone. All right. Some of you that have better connections might be able to do it in far less number of pitches. Some of you may need to do far more, but I always start with the assumption that this is going to be a grind, right? Convincing people to believe in your vision this early when you're like pre-seed or seed stage is tough, right? So be prepared to sort of clear out your calendar, run a real process, and then do these meetings in a very serious and aggressive way to unblock yourself on capital. For our first fund, Hustle Fund 1, we were $11.5 million fund, and we pitched 700 people to eventually get to 70 investors that filled up our VC fund for our first fund. But it gets easier. Okay, so let's talk about that scheduling of pitches. So we talked about this method of warm introduction, and I wanted to just give you this example. So we're going to go through like a step-by-step process of getting to reach out to that angel or VC. So first step, as I mentioned, was just go on LinkedIn. Right now, I last night went onto Elizabeth's profile. She's my Hippo-loving co-founder. And I said, like, okay, I want to just take a look at her LinkedIn, click on all the secondary connections, and list out everyone that we share. And there's a lot of people that we share in common, but also that she has secondary connections to whom I can ask for warm introductions. So that's step one. I think this is one of the most basic blocking and tackling things that you can do in beginning to fill your list. Okay, the second thing is this. So a lot of founders actually really skip this step, and it is to their detriment. So when you're asking a friend, a family member, an investor, a colleague for an introduction, do everything possible to avoid them from doing work, right? So you don't want them to do any real work. So the easiest thing that you can do is to set up a referral blurb that they can forward over in like 2 seconds. And I have created one here, which is like, okay, I'm Kara. I'm trying to ask like Eric for a warm introduction. So I'm going to provide this template for Eric, I guess to refer over as quickly as possible. Let's break down what's actually happening in this email. So the first is this, section 1, simple request for the referral. So right now you can see that in like 1 to 2 sentences, I'm like, I want to contact this person. I think it's going to be interesting for her. Can you help me? Right. And it's forwardable really quick. So let's take a look at the blurb. So under the ... here, I provide a very pithy explanation of what my company does. I share 2, maybe 3 very sexy points about what the company has achieved to date in terms of products, traction, whatever it is. A mistake that I often see here when it comes to this section, the sexiest details of your company section, is that people try to like be so comprehensive. They're like, oh, here's like the 50,000 things we've done, and this is like a 7,000 word memo or something. Don't do that. This is all about progressive discovery. When you go on your first date, you don't talk about your family's history of like mental illness and like the fact that you haven't spoken to your mom in like 17 years. Like you only talk about the pleasantries first. When you get to date number 2, 3, 4, 5, 6, 7, whatever, that's when you start to introduce all the fucked up things in your life, right? So, and then hopefully by the end of it, they still love you anyway. That's at least how it worked out with my wife. So only a couple sexy details here. And then I like to usually flex with a little bit of team after the sexy details of like, Kara and I have been working together for like 15 years. We've shipped like hundreds of millions of dollars worth of revenue or sales. And then a nice to have, but not always, is if you have a teaser deck, so like a short version of your deck, that isn't, again, like the full thing, but maybe like 5, 6 slides to provide some additional color. It's nice to include that as a doc send link. And I recommend doc send because it allows you to track who is opening your documents. They have to provide their email, as well as seeing like where they're spending their time on each slide. It's really stalkery and really amazing. And then, of course, contact information. I can't tell you how many blurbs I've seen where I'm just like, how do I contact this person? Maybe it doesn't matter because it's a warm introduction. So that is the breakdown of a good forwardable referral email. Let's go on to the next step here. So let's talk about this this flywheel effect. So, all right, you're like, dude, this all sounds great. I came up with a list of like 50 people that I want to talk to, but that's all the people I know. I only know 50 people, right? Like, how am I supposed to get to like 100 people for 100,000 pitches? Well, let's talk about that. So, step 3 here is when you get your investment in from any angel, regardless of check, you need to ask that person for a referral to another investor. But the way that you do it really matters. The mistake I made personally in my career when I was fundraising for Hustle Fund was like, yo, Kara LP, thank you so much for investing in Hustle Fund. We're excited about the journey. Here's my forwardable blurb. It's perfect. Here's my teaser deck. It's perfect. Can you send this to anyone who might be a fit for Hustle Fund? And the response to that request was silence. Okay, no one, it's too much paradox of choice. I was making her think of just like, shit, like, who are the people that would be a good fit for? Like, this can be like 20 minutes of work or something for me to like think about this. You're like, no. So ironically, the better way of doing this is not to ask who is, send this to everyone. It's actually who is the one person in your network whom you think would be a good fit to invest in my startup. One person. Okay, why does that matter? It reduces the paradox of choice. Now it feels psychologically that Kara only has to spend 5 seconds of work to consider just one person. That one person is also going to be generally the most qualified person for having fit with your company too. So the quality of conversation and conversion rates can be higher. And last but not least, this almost always happens, especially with angels, it tends to be the richest person that they know. So I'll tell you a really quick story here. At Hustle Fund, when we started, we didn't know a single person that operated these family offices. Okay. Family offices are a different kind of entity. They tend to be just like the private investing office of a super duper rich person, right? Generally billionaires and so forth, right? There happens to be a lot of them around the world, but none of them want to be known. And that's not true, but a lot of them do not want to be known. There are some family offices that are so secretive. They have no website, no contact information, no LinkedIn, no presence at all, no way to actually find them on Google. But they operate like, $50 billion of assets. So family office people know family office people. And what happened was like when we started running the flywheel effect of just like, hey, Kara, who's the richest person you know? And then the Kara responds like, oh, it's Jasmine. And it's like, hey, Jasmine, who's the richest person that you know? We started to hit this like family office circuit thing. And in addition to that, like other corporations, multinational corporations, and then other financial institutions and so forth, it just created this up leveling so quickly that allowed us to unblock bigger and bigger and more interesting chunks of capital. So I think the same strategy should be applied here when it comes to your own fundraise, which is ask for one. And ironically, it's going to produce far better results and far bigger network. This is how we grew from like 100 people that we knew to like 700 in our first fund. Okay, I guess I just anticipated exactly the punchline here for my slide. I'm kind of sad because I picked these emojis just for this reason. I thought it was gonna be funny, but all right, let's move on here. So a few things here. We're gonna talk a little bit about the mathematics of a VC fund, and this is something that is a little bit technical, and I'm going to be I guess I'll be a little bit hand wavy in the math here, but it's important to know. So what's in it for angels in investing into founder Kara's company? Right. So what's in it for me when I was an angel investor was like, okay, I'm going to give you some money, and dude, it'd be great, or dudette, it would be great if you return my capital back or give me a little bit more than that. So I thought the win was just like, I'm supporting a friend. So if I just get my money back eventually someday, that's cool. If I double it or triple it, that's amazing, right? I can turn like $50,000 into $150,000 or something, right? So there's a different kind of threshold that's needed because it's my own cash that we're risking here. And like doubling money is like, sounds cool to me. I sort of alluded to this earlier, but VCs cannot operate in that way. We are soliciting capital, very large chunks of capital, and stewarding wealth of a lot of different kinds of LPs. And the way that the mathematics work is, it turns out that if we just score doubles for a bunch of investments and a bunch of others fail, like we actually are really at high risk of not even returning the original investment back from our LPs. This is actually kind of like a very difficult concept to understand. But the way that you actually make money in venture is by betting on teams that have the potential to 50x or 100x your initial investment if you're a seed investor. So let me explain how this works. Venture capital works on a model, on a theory called power law, which means if Kara and I decide to invest in like 100 companies and 99 companies fail, and we lose all the money for all 99 companies, but one company is like Facebook or something, or TikTok, which produces like, 1,000x return or something, that return winner is going to pay for all the losses. Okay. Because, it's such an obscenely great outcome just on that one company. And we will actually be perceived as really good investors, even though 99% of the time we were wrong. So when you start to play this out into a lot of venture capital funds, you have to assume that the majority of the companies that they're going to invest in are not going to return back the original investment, or downright just lose all the money. And therefore, there's a critical few set of companies, like 1 to 3 or 5 or something like that, that will be like an outlier winner. That's going to be the returners that is going to lift up the ocean again, right? That is depleting down due to the climate change of failure. So in order for the math to work, that means that you have to bet that at least one company is going to have this ridiculously huge outcome. And therefore, like, it'll average out the math to be like, okay, we have that 150x outcome, everything else is a loss, but now we're turning like 3x the money for our investors. You can sort of play with this on a spreadsheet, but know that is expectation. So one sort of side caveat here is, like, sometimes I see a pitch deck that's like, we have high confidence that if you invest in us in 3 years, like, company X is going to acquire us and we can return back 3 times or 5 times our money. Oh man, that is like the unsexiest thing that you can say to a venture capital firm, right? That could work for an angel who's like, cool, I can 5x my money. That's sweet. For a VC, that's just like, this is like rounding down to zero. Like, we're better off trying to take a riskier bet on a founder that's more ambitious, right? We can talk about this more in the Q&A if there's questions about this, but that is a very big difference in terms of the messaging of just like, for a VC, it's like, we are on a path that is going to be an outlier winner, the fund returner for you. For an angel, it's just like, I'm going to make sure that you're going to make more money than you're investing into us, right? Okay, so I think I'm pretty much at the slides, and yay, like, I wanted to leave a plenty of time for Q&A here. So I did want to say that, like, things that we didn't cover today are just like the construction of your pitch deck, some of the mechanics of like what you should say and show on your slides. We actually have a very active set of videos on, I guess, like webinars that we've recorded in the past. So just Google Hustle Fund, or search for Hustle Fund on YouTube, and you can see all of our videos. I did one on building the perfect pitch deck a while ago. Elizabeth did a great one on angel investment only. So take a look at some of those videos. And with that, let's go ahead, and I'm going to stop sharing. And I see my awesome colleague, Kara, has returned back to video. Kara, was there any like questions or anything interesting that you saw from the chatter or the Q&A that we can talk about?
No, we should just close it out, Eric.
Let's end it right now. Great.
I'm just kidding, you guys. We've got 33 questions and counting, not including the ones that I have answered with my keyboard here. So Eric, we got so many good ones. I say we start at the top and work our way down.
Let's do it.
For everyone who's asking if we are recording this, yes, we are. For everyone asking if there's a slide deck we'll share, yes, there is. And for everyone asking if Hustle Fund invests internationally, yes, we do. Predominantly in North America and Southeast Asia. So I see a lot of those, so I just wanted to get those out of the way.
Thank you so much.
Great. Okay, Eric, you ready?
Yes. Let's do
Okay.
it. I just took a sip of coffee. I'm ready.
Do you think there are any changes around VC and angel investing trends during the pandemic?
Good question. So at the start of this year, me and Kara were sitting down virtually because of the virus, talking about this topic. And our prediction in the first quarter, once things are ramping up, was that this is going to be a tough year. I think that a lot of investors are just going to sit on their hands. Are we about to enter this like crazy Great Depression, where some people are going to be hurt and like the economy is going to be hurt, and no one's going to want to invest? And like the answer to that, like today, like almost like November of 2020, it's actually October 28th today, right? Is that it's yes and no. So like yes in the sense that like a lot of families are hurting. I mean, unemployment's in a very high level. There's definitely like a lot of pain here, and that's something that like existentially is troublesome, I guess, about this moment. But the no is what I didn't predict was the US government has pumped a lot of money into asset allocators and as well as like public equities in their own way. Just like there's a lot of capital that's flooded in, and therefore things like stocks have been performing really well. So rich people tend to put a lot of their wealth into owning a bunch of stocks, owning a bunch of funds, and so forth. And largely they've done quite well this year. So the wealthy people still feel quite wealthy, and they are opening up their pocketbooks because they have risk tolerance because of their wealth, to do angel investing. For VCs, there's a slight period where in Q2 and Q3, like VCs did sit in their hands a little bit, but it came roaring back. So like towards the end of the summer, it was just straight fire. Like I hadn't seen this kind of level of activity of funding frenzy happening. So so it feels like 2019 right now, which is a strange reference. 2019 was a very frothy year of venture capital investing. A lot of money went into founders. And right now it just feels really hyped up. That said, I'm going to say this, which is if you're thinking about running a process now, I would be cautious. I don't think it's a good time of year. So with the election happening next week, Thanksgiving, and then the holidays in December, generally like people are slowing down just naturally, but more so I think just from this year and the havoc that we've gone through, a lot of people are just like excited to cancel this year and be like, yeah, screw this. Let's just wait till 2021 and get back. So my recommendation is that if you have enough capital to make it through Q1 of 2021, if I were a founder, I'd probably wait to run like a larger process then. But that said, if it's only like a couple $100,000 you're trying to rile together, do that through angels. And angels are available whenever. They don't really care about seasonality or are as sensitive about it as VCs are. So hopefully that answers that question.
Oh, that's great, Eric. Thank you. I guess one quick follow-up to that is if a founder does decide to hold off on raising until 2021, do you recommend the next couple of months to focus on building relationships, or would you hold off on that as well?
Oh, really good question. So I think that the list building activity is a good way to spend the slow season, right? So I wasn't as explicit about that in the presentation, but those tools I mentioned, actually on the slide, like NFX, AngelList, LinkedIn, the goal is actually to translate those contacts, those angels and VCs onto some sort of spreadsheet of initial targets that you want to go after, right? So a really good best practice in this process is to make sure that you document everything about like, who did you contact at what point, what's the status of the conversation, did they say no, for what reasons, etc. Or did they say yes? Who did they refer, and so forth. So that is a really good activity. So if you can get to like 100, 200, 300 people, right, on a lead list, it's a great way of doing it. And if you have some extra time too, doing a little bit of LinkedIn stalking of like who do I have second degree connections to get to Kara, right? Is it Eric or Elizabeth or someone else? That's also, I think, a really, really good way to spend your time so that you are ready to go with all of your leads, but also maybe your assets too. That's the other thing to do in November, December, of just like your short deck, your blurb that's forwardable, and your long deck. So you can hit the ground running in January.
Love it. Thanks, Eric. You mentioned something just now. We have a couple of questions about this. Let's just touch on that. When it comes to asking someone for one referral, do you recommend that these entrepreneurs go into LinkedIn and actually like pick out the person they would like to be referred to? or leave that decision to the person that they're reaching out to?
So that's interesting. I haven't considered this strategy before. So I generally like to leave it to the investor to have agency on selecting whom she wants to refer you to. LinkedIn could be okay. And maybe you could do both, which is just like, hey, I was thinking it'd be Kara. But if you have someone else in mind, that could be a better fit, then I'd love to like follow your lead here. The reason why I like to give the investor choice is that normally they have insider information about their network that's better. So it turns out Kara could be like a terrible sexist, right, or something, and that like is not publicly known. By the way, if this, I know this is recorded, Kara is not sexist. She likes everyone. Yeah. So, but like there's all sorts of like weird stuff that about your network that is a principal agent problem, right? Like the principal whom you're trying to get help from doesn't necessarily divulge all this information to everyone. So relying on their lead, I think, is the right thing to do. But in addition to that too, of course, something that I didn't mention as a good best practice is when the introduction is made, regardless of outcome, of whether the new person that was referred invests or not, you should follow up with that referrer and thank them. And maybe you can get another shot on goal. So if the person, investor didn't invest, just say like, hey, this is a great meeting. So thankful for this. Like, I don't want to trouble you again, but is there like another person? Right. I wouldn't like do this like 15 times, maybe like 2 or 3 times, because again, like you don't want to be, parasitically using that relationship so much like this. And again, you want to create as little work as possible.
That's great. Okay. Is there a danger of giving away too much equity by taking angel rounds early on?
Absolutely. So do you remember my first slide or earlier slide of like, don't do this, right? I mean, like, okay, let's talk about the risk. One is this, which is like me and Kara started a company. We could have bootstrapped it, had like a really good outcome. We didn't. We got $100 million outcome, but now we own like 2% of the business each, right? So now we have like $2 million, and that's cool. That's like a lot of money, but there's easier ways to do that. Like maybe we should have just been product managers at Google for 10 years instead of running this company for 10 years and made probably a lot more, right? So like selling the equity gets you on the equity train where like, so I call like VC, and this is like probably extremely like rude example, but like a cocaine addiction. Not to say that I know what cocaine is like, but like, once you begin it, you actually need to keep doing it. Right. So like you start with less so on angel rounds, but like once you start like a venture financing round, you got to do another one each year or 2 years. And what I mean by that is it's not necessarily that your business needs it, but the expectations of your growth, the pressure that you're going to get from a lot of VCs to get to the next milestone is going to be driven by like how aggressively can this team grow, right? So like it just creates this kind of dilution train that is endless before you get to your IPO or whatever. And hopefully you have enough equity for yourself and your families, like where like it'll be meaningful by the end of it. Anyway, so like, but the other, let's talk about the more like heart of this question, which is around if you oversell. Let's say that me and Kara start a company and then we sell like 35% of our business to investors. When we come up for like another seed raise or a Series A, we actually might automatically be disqualified because we have a messy cap table. So I mentioned this in like an earlier presentations months ago, which is like, you should try your best not to sell more than 25% of your equity at the seed stage. If you start to exceed that, maybe it's okay at 30, but if you start to exceed that, then downstream investors like your Series A and Series B investors can be like, there isn't that much like cap table left for me to invest in. And I'm not convinced that they're going to be able to like have any meaningful ownership as founders, or just for me to actually be able to like sell this to future investors to get them to their IPO because it's been oversold. So try to be lower than 25%. If you can do it, sell like 5% or 10% only, if possible, right? So this cap table thing also is one of those things that I did not appreciate. We served up some deals before in the past from great founders, great businesses, great traction. Everything is great. The cap table's messy, right? And it forces you into 2 choices. One is like, just don't raise because you can. So you guys just skip the Series A and wait for the B, or recap your investors, which means like you go back to your angel investor, Kara, and be like, I know you gave me $100,000 for 10% of the business. I'm going to keep the money, but reduce your ownership to 5%. So you cool? That's never a good conversation.
Does that work? Has that ever worked?
It happens all the time.
Ooh.
And it never feels good. So let me actually talk about this because many of you guys might have already screwed up and done this by accident, right? So like, let's say that you got a recap and you're approaching me, all right? It's like, Eric, I'm you right now. Eric, like we have to have a serious conversation. Like there's a lot of potential in this business. I'm getting tons of investor interest, but the issue is that the cap table is oversold. I'm like, oh, okay. Well, what's the solution? And you say, well, we're gonna have to recap you down. I know you own 10% of the business, but I need to free up 5% to take in investors. I'm gonna be like, hell no, I've already taken so much risk on this business, right? I want my equity. And you say, no. Like the reason why this is a good idea is once we get this investor, it's going to unblock us in this next area of growth. The pie is going to grow bigger. So even though it feels like 10% is, or 5% is less than 10%, what we believe is what we're going to return back to you for your 5% ownership, we believe will be far larger than what we could have returned for you at your 10%. And then normally I'm just going to like keep on bitching for like 5 more minutes, but at the end of the day, it's just like, it's the right thing to do for the business. Okay. And I'll be like, okay, fine. Right. So it's horrible. Imagine doing that like 20 times, right? And sometimes people aren't that cool. Like they're going to like threaten lawsuits and all that stuff. They never do. I mean, they'll threaten them, but like, what are they going to do? So we should probably move on to another question because I can keep going on and on about this. But just try to keep your equity sold less than 25% at the seed stage, and you should be okay for future fundraisers from VCs.
Great. Thanks, Eric. Sounds like we should do a whole event on maybe just cap table down the line.
Yeah, it'll just be me talking to myself like a psycho, just like, but Kara, no, all that stuff, right?
Okay, let's move into something different. Do you think that it's wise to pursue VCs or angels that have invested in companies that you are trying to disrupt or become a competitor of?
Don't do it. So the reason why is just like, so I don't think that I see this too much. Okay, this is one of the things that actually a lot of VCs don't like to talk about publicly, but there are too many occasions that I've seen from a founder that I hear about that they go pretty far into the process. They reveal a lot about this incredible technology, and then the VC is not forthright, or maybe is slightly forthright about a competitor that they've already funded. VCs have very unclear rules when it comes to how they handle competition within a fund. And sometimes they'll just take that information and just forward it all directly to their existing portfolio company. This happened actually to one of our portfolio companies once, right? Where like someone was not being forthright. They basically stole all this information about how they're running their customer acquisition and so forth and gave it to a competitor that they were not forthright about, right? I find that to be ridiculously unethical. But is it illegal? Absolutely not. So I get very nervous about that. If possible, I would exhaust all of the options for non-competitive funds and angels first. But sometimes survival is survival. And if people are going to give you a check, even if you know that there are these kind of crazy conditions, you may have to eat it and just like take that terrible choice, but avoid it if possible.
Okay. That's great advice. How can one best draft up agreements for angel investors, especially when there's limited capital to hire a lawyer?
I love this question. So thank you so much for asking it. I have a solution for you. Avoid all the lawyers. Go to the Y Combinator website and download the YC Safe, right? So the YC Safe is the gold standard of angel investment. You just go download the form. I say like, Kara, I want to give you money. She's like, cool, here's the valuation. I'm like, I love it. Here's $25,000 at like a, X $million like post money valuation. I sign, you sign. And then Kara's like, here's my wire information. Send you the wire. We're done. It's a standard document. The terms there are vetted by lawyers already. It is completely free and it's all good. If you decide to do a price equity round, like I'm some sort of crazy VC and I'm asking to like invest in a traditional equity raise, I don't know. I would try to push back and still do safes until it's a little bit more substantial. Like if it's like $3 million of money that you're raising, maybe you want to do it as price equity. But just know that the standard operating practice is we lawyer up and then we produce this document, it'll cost between $15,000 to $30,000. You as a founder pay for it, not the VC fund. That is the standard right now. And when I learned that, I was like, that is really fucked up. I mean, like, that could be like 1 month of burn for you. It's the standard though. And as a result, like we rarely like to do price equity rounds or lead those. Like we always try to push founders for safes, because we'd rather just you turn that money into like hiring someone or just building some products, right? So YC safe, Y Combinator safe, go to the website, Google it, whatever.
Great. Awesome resource. We'll include that in the email tomorrow, you guys. I'll link to that as well.
Thanks, Kara.
Okay. A lot of questions on crowdfunding. First of all, what are your thoughts on them as a possible revenue source? And also, do you think it can negatively impact your ability to raise from angels or VCs down the line?
Yeah. So let's talk about, there's almost like two answers here. So crowdfunding, I think, is pretty cool. I mean, like if me and Kara were starting like a, custom mug company here, right? And we want to get our users excited about, buying it, and also possibly being like a minor stakeholder in our journey. Like when like the consumer is also like the investor too. There's like models where, especially in consumer products, where like crowdfunding can be really powerful. A while ago, they're like, I forgot what that smartwatch company was. I think it got acquired by GoPro, but they were like a huge company. And even then they would crowdfund. It was Pebble. Thank you so much, Kishan. So Pebble like was a big company. They're making like crazy amounts of revenue at their peak, but they would still do a crowdfunding campaign every time they released a new product. Actually, that's not necessarily true. They would do, I think, pre-sales that way. But that's a terrible example. But there are versions of this where it's just like, it was like a pre-sale, but as part of that, you also get equity in the business. And it can make a lot of sense just from a business perspective and like a consumer relations perspective. Now, from like signaling for a VC, I never really understood this. And I still don't. But a lot of VCs just view that as janky. Now, if you're to approach us at Hustle Fund and you're like, I crowdfunded and all this stuff happened, I'll just look at the cap table and be like, okay, cool. Like you didn't oversell and like there's a journey ahead and we can work with you on that. And let's just do it. Right. Like we've done this before with all the other founders, but there are some VCs out there that are just like, this looks like amateur, right? Like, and okay, I'm going to introduce like a theory that I learned as a sociology student in college that I think is very important. It's called the theory of like tautological fallacy. And I really hope I remember this correctly. So it's like, if something is happening now, there must be a reason for it. Therefore, that's the reason why it's happening now, because there's a reason for it. Therefore, it's happening now. So the tautological fallacy is just like, if Kara, let's pick on Mike, who I just saw. Mike, you don't need to turn your camera here. If Mike is crowdfunding, then therefore it means that he couldn't raise from like a top tier VC fund. Therefore, that's why his crowdfunding is, because he couldn't raise from a top tier. Like you can see this like a negative recursion of just like, oh, like it is what it is right now because there's a reason, and there's a reason that's why it is what it is, right? So some people will view like some of these crowdfunding platforms be like, oh, they're only doing this because it's like a backup. They had no real strategy of being able to ever raise money. That's dumb. There's no logic to it, but I have to say that a lot of VCs have this bias. Okay. So think about that. At the end of the day, though, I think it still could be overcome. Like if you have like an airtight reason of just like, look, dude, the reason why we did this is we have the type of product where we want our community to feel ownership in our journey. And it was strategic. That's it. Right? Like if that's the reason, you just deliver that line and just like drop the mic and drop the coffee mug for me and Kara's sake, then like, you're good. So, all right. I'm going to stop talking, Kara. I'm just going to keep going forever.
I think you did a good job with that tautological reasoning, Erica. I feel like if your college professor was here, she'd be happy with your description of it. So great. Good for you. Now you can graduate. Okay. Can you talk about how to close angel investors? Anastasia had a commitment from one for part of the round, and she's not sure if she should wait until she gets more angels committed or go in for
Yeah.
the close right away.
Thanks so much, Anastasia, for that question. So I got a solution for you, lady. Is that I am a huge believer in tranching your fundraise. Okay, let's explain what this means. So Kara's just like, oh, hell yeah, dude. So like tranching is this method of breaking up. Let's say that me, Kara, and Mike are starting a company and we want to raise $500,000 in this initial fundraise, right? The amazing thing about raising money via safes is there's no concept of a round. What that means is like in a traditional round, it's like we're raising $500,000, but we're waiting for a lead to set these terms, help us construct these legal documents. All these, they might put in 200,000 out of 500,000, but we round up another 300 grand. And then all of us have to sign the same document at the exact same time. And then the money gets wired. Okay. For safes, there's no concept around, meaning like I meet rich person Kara at coffee, and then she's like, I love you. I'm going to give you 200 grand right now. Cool. We signed the safe. She wires it the next day. Then I meet Mike. He's like, I love this. I'm going to put in like $5,000 because he's so much poorer than Kara. And then, boom, we signed the safe and then boom, we keep going. So with tranching, what you do is I believe that you can break up this 500,000 raise into like maybe 2 or 3 tranches. Maybe for the first $250,000, what you should do is set a slightly lower valuation. And you say like, yo, because you're cool and I want to do like a miniature friends and family here, only for the first $250,000, we're going to give you these really, really nice terms. It's at a $3 million valuation, right? But once we fill this 250, I have a lot of investors in the funnel. I'm going to raise it to $5 million. Okay. So you create fake urgency and fake scarcity to FOMO in your investor to say like, this is going to go fast. This is like premium terms. You're going to get way more ownership for your money, but there's a limited supply, right? And then you fill that up and then move exactly to like a higher valuation cap. So the safe is exactly the same. The valuation cap that you're putting on the document is just now from 3 million to 5 million. That's the only difference. Again, no lowering required. So I think that this is the way that you do early fundraisers. Like you start at a lower valuation, you just keep raising the cap every time you do the tranche. And this actually is very common and standard practice. We actually were in a round where we invested at one valuation. The very, very next day, the founder created a new tranche at a much, much higher valuation and immediately filled it, right? Because of the investor demand. And it's cool. Like it is sort of what it is right now, where founders can have some of that optionality. So think about using that as FOMO, as this tranching methodology. I think we actually had a pretty good video about this, Kara, from one of our previous sessions too, where founders can take a look at that on our YouTube.
Yeah, we'll send that out too. Eric, is there any risk of that backfiring if you don't fill the first tranche quickly or at all?
Yeah, sure. I mean, like if you don't fill the first tranche, then there's like a pretty big problem here, right? I mean, so I think usually the problem is as follows. One is like, are you setting the valuation cap wrong, right? Is it too high? Usually. So like too high given the traction they have or so far, or progress in your product so far. So maybe you need to sort of like reset that to see if there's other kinds of demand. Or the other is just like you haven't done, or you more, not you haven't done. It's like more work needs to be done in terms of just like driving up the lead list. So this is something that we coach a lot at Hustle Fund with our founders. But when you're running a process, you should really condense it in as limited period of time as possible. So what we recommend for teams that are raising like, let's say substantial round, like $2 million in this case, is that, and it requires, let's say a lead too, is that they condense it into a 2-week process where they try to fit in 50 or 70 meetings over 2 weeks. And the reason why you want to do that is to try to get everyone to consider the opportunity at the same time, ideally set terms for you and offers for you at nearly the same time, and hopefully create an auction process around you. So if I can FOMO Kara Fund and Mike Fund into investing in me, Kara's like, I'm going to do this at like a $5 million post-money valuation. Mike's like, I'm going to do it at 6. And then Kara's like, I'll come back and do this at 6.5. It's like, oh yeah, right? Like just like I'm getting less and less diluted. I'm just letting the auction run. You have more leverage to say like, well, Kara, like tell me about your values and all this stuff. Really get deep into those people. So the big mistake that I see is people do it ad hoc. It's just like, oh, I got a random investor introduction. I'm just gonna like schedule it tomorrow. And then, oh, I got another one. I can schedule it like next week. You got to condense it all into one thing, right? I think that's your best path of actually getting the FOMO as well into that tranche.
Okay, great. And then Eric, I guess for probably our last question here, I want to talk a little bit about projections. We have a couple of questions here. I'm gonna read you like two and see if you can answer it all in one sort of lump. Okay, so Oliver says, I understand the need for a 50x return from VCs, but if you're pre-revenue, are those projections just big what ifs? What's the best way to present this? And then on the other side, Paul is asking, you mentioned not looking ambitious enough for VCs. So does that mean we shouldn't do realistic financial projections, or how would you approach that?
Oh, these are great questions. Okay. The first on like 50x. Sorry, can you repeat that question one more time?
Yeah. So if you aren't pre-revenue, are those projections just big what ifs? How would you present it?
Okay, let's talk about. Okay, I see how we can condense both. Okay, so everything that you're sharing with me at the pre-seed stage as a founder is bullshit. Okay, and we're just going to assume that it is just all theoretical at this point. Really, like, what are we going to judge on? There's no product that's really built out yet that's like in decent shape. There's barely any traction. Maybe the pilot. Maybe you have like 1,000 users on your gaming app or something. So the what we are selling to our investors at Hustle Fund is like we are accepting that there's ridiculously high risk, but that's also going to be reflected at a much lower valuation by which we invest. And even though, so on the risk adjusted return, it's like, because like Kara is like talented and we're really trying to focus on the founder's talent, we think that she's going to figure it out, even though we don't have like all the data behind it yet. So, we're betting that at the low valuation we can get into, that achieving 100x is certainly possible. By the way, the lower the valuation, the easier it is. If Kara is raising at like a $10 million valuation, that means that she has to reach a $1 billion outcome in order to hit 100x. If she's raising at like a $3 million valuation, she has to hit 300 million. The universe of companies that can acquire a business and the hundreds of millions of dollars versus the billions of dollars, I think is 10x larger at the hundreds of millions, right? And that's actually what we also sell to our investors too, that we don't need a single unicorn to have a fund returning outcome. So it's all BS, okay? So I think it's more about, for me, like I think when you're talking to a venture capital fund in Silicon Valley, it should be less of a conversation about the nuances of the mathematical model, whether it's realistic or not, and more about the team. I think it's more like 60% about like, look at our track record in building together, look at what we built so far. Here's how we think about running customer development and sales and so forth, and like any evidence that's presented there. And I largely think that most decisions can be made based on just the quality of the team at that point. Now, there are like areas where math matters. So like if you're trying to size the market and show that this isn't some sort of like tiny niche thing where it's only like a $50 million market, but it's actually measured in the billions of dollars, and here's how you mathematically get to that, I think that's really fair. But when it comes to just like P&Ls for the next 5 years, who knows? Like this is, you're like, as early stage investors, I think there's a litmus test that needs to be passed for a VC or an angel, which is just like, are you going to have my back and trust me that I can figure this out? Because there's going to be pivots, both small and big, along the way, customer development that dramatically swerves the business into an exciting new kind of future. We invested into a crypto business that eventually became a yoga app. That's a pretty big swerve, but the founders are great. And the only thing that those VCs and founders should do is say thank you, of just like, you are doing your best in stewarding our wealth and, trying to produce a great outcome for your investors and yourself. So if a VC is really going to harp on things like, well, your 4-year expense item on line row 42 is like, producing this, it's like, just get the fuck out of there and be like, look, you don't seem like a good fit for us. Like this is like a big dream that we're realizing. So rant over. And I think that's going to be the last question for today, Kara.
Unfortunately, I think it has to be, Eric. That was such an awesome answer. Since we started this Q&A, we went from 32 questions to 86 questions. So we have so many great Qs here in the pipeline. I wonder if you'd be open to answering a couple on Twitter, maybe, if someone.
Yeah, let's do it. So I'm at Eric Bahn, ERICBAHN. Oh, thanks, Kara. She just threw that into the chat. And that's probably the easiest way to get to me. I'm very active there, and I love to see these questions. There have been so many here. Thank you all so much for coming to today's session. And a big thank you, of course, to our sponsors, GS Futures, for helping us to underwrite today's session. We expect to see some nicely edited full video clip and snippets coming out of this that they've helped us to underwrite. And a huge thank you to GS. But by the way, I just want to also recognize my amazing colleague, Kara Demars, here, who is moderating these chats in this entire series. This is her last week before she goes on maternity leave. And Kara, I just want to publicly say that we absolutely love you so much and appreciate what you do. Our community loves you too. And I'm so excited to meet your little one soon. So good luck with that too.
Oh, thank you guys so much. Okay, well, thank you all for being here. Eric, you're the best. Audience, you're amazing. Thanks for being here. And I guess we'll see you all next time.
Thanks so much, team. Stay safe.
Bye.